Good day, this is Graham Bibby here, and I'm really pleased to be talking to you today. I'm so excited about the upcoming Millionaire Masterclass organised by Darren Stevens. Right in front of you now you can see part of my Empowering You series, and I'm bringing to you free my top 17 stock market trading tips. Right now as I'm talking to you, I'm on the paradise island of Phuket. I'm sat here in shorts and a nice short sleeve shirt, but in the picture in front of you, you can see this is my normal business attire, and this is about the ultimate business, and it's the business of money. So please sit back and listen. I am a regular speaker on BBC, Reuters, RTXK, which is Radio Hong Kong, Bloomberg's and CNBC. My new book is coming out soon called Master Your Mind, Master Your Money. But let's get on right now to the 17 stock market trading tips. So from me, welcome. I'm pleased to give you this free gift. All these tips are covered in depth in my books and on my stockmarketnewschannel.com and howtotradethestockmarket.com and the soon to be live grahambibby.com, which has got a bit of my life history there. So some of you will know that I've created a lot of things in my time, but a lot of you might not know that I come from government housing originally in England. So I came from a very working class background, but I was driven. The law of attraction really came to me. My vibration level was high, and I've built homes around the world, and homes in England, in Tenerife, Hong Kong, Phuket, Singapore, and Australia, and in New Zealand. And then I envisaged a 92 private pool luxury villa resort, where I'm pleased to say the Millionaire Masterclass is going to be held. I envisioned it, I'd never done it before, and it is a real top class resort, beautiful spa, fantastic restaurant, great chef, lovely gym and a beach club, and I've even got a 4-bedroom catamaran that we go out cruise around the islands. And if I can do this from my background, I'm sure you can do it. And I'm going to show you how to do it. So here's the 17 trading tips. The first one, tip 1, is look at the big picture and set in advance your course of action. Quite often on TV I hear people saying, you know, this stock is gone from 20 in the past few days, it was 21 and 22 and then 23, and they say how strong the stock is. However, when you step back, you may see that the week before or the month before it was trading at 25, and the week before that it might have been 30. So you need to start off by looking at the big picture where the big trends are, and then you zoom in on the more close-up action, the zoom in for that closer time period. And when you come to the Millionaire Masterclass, I'll be showing you all this. I'll be showing you how to make this money and how to simplify the process, the business of making money from the investment markets. Then your second tip is you've got to be prepared to be wrong and know in advance the action you will take. If you're not prepared to change your mind, you may soon have no change to mind. And change meaning money, coins, it's one of those funny sayings. And by this I mean if you buy a stock, you should do it for one reason only, because you believe it will go up. And if it doesn't, why are you holding on to it? Usually you start losing some money, you don't want to sell, I don't want to lose money. What you really mean is you don't want to feel failure by selling. But hey, if the stock is falling, it's doing the complete opposite of why you bought it. If I'm looking at the current trend, you would not be buying it today, get out. The saying is, if in doubt, get out. Be prepared to re-evaluate and change your mind. You see, the whole key to this is keeping winners and dropping losers. The key is to run big profits and drop small losses. And I can tell you right now, in this last 12 months, and I'm speaking to you now, and it's July 2013, in this last year, I have stocks that have gone up over 100%, and we're still holding them. I will speak to you later on a bit about Apple, where we bought, how we held on all through the rise, and then we got out when everyone was talking the stock up. Anyway, tip 3. No matter how good something looks, you need to divide your capital into 10 parts, ideally. Sometimes you might, if you've got a larger amount, you might divide it into 20 parts. And never risk more than 1/10 or 1/20th of your capital on any trade. Ideally, never place more than 5% in one stock. This way, if you understand my secrets to success, you will know you run your profits, cut your losses. I can't say that enough. If you divide your capital into 10 and you lose 5%, but make 10% on 5 trades, by cutting your losses and running your profits, you end up with a net 5 times 5% losses, which is 25%. However, if the rest of the time you just made 10% times 5 is 50%, so you'd end up with a net 25%, even if you were right only half the time. Now imagine this. My clients have had Visa since 87 and it's now 192. That is over 100% return in just over 12 months. You could make 20 losses of 5% and only one success like that, and you still wouldn't lose money. You see, the solution, the key, is not how much you make when you're right, but how little you lose when you're wrong, or should I say, when the market goes against you. We need to keep the losses small. Tip 4. Making money is simple. It's simple. It's also boring. People want excitement. Excitement is not the place here. It's simple, but it's not always easy unless you follow a system, because otherwise your emotions get in the way. You see, most people just buy on hearsay, rumour, a tip, maybe a TV tip, a friend's tip. It's not from any planned approach. When they do have a plan, they give all sorts of reasons why they break the rules, like, I can't sell now, I'll lose 20%. Instead of getting rid of losers and keeping winners, have a system, a plan. You see, people don't plan to fail, they just fail to plan. Have a system, a proven methodology that identifies trends at an early stage, has many management rules, how much to invest in each stock, know how and when to buy, and more importantly, the most important thing, when to sell. You see, everyone tells you when to buy, but who's telling you when to sell? The key to success is the selling aspect. Keep your losses small. Losses are a cost of doing business. You just need to keep them small, like with all businesses. Anyway, let's go on to tip 5. Always use stop losses. And I prefer to use mental stop losses, and that means I don't give them to the broker. I don't place them into the market, because some days, one day's market action, you might be through the stop loss, and then by the end of the day the stock might be minimal down, and that's called a key day reversal. That's a bit more technical. So I just like to look on closing prices, and if then we're below our stop and it wasn't a day when the stock was down a lot and then it recovered, then I'll be selling. There are levels at which stocks fall below and you just sell. You protect your stops with the stop loss point placed 1%. It could be below the last 2-day bottom, 2-week bottom, or trend line, if you like. Some people like to have stop loss levels trailing the stock at about 8%. However, from my point of view, I think a picture paints 1,000 words. And sometimes you have a big run up in the stock. Something like Apple, because that's been in the news a lot. From time to time, if for example this stock would have a strong run from 200 to 300, it would cause more people to take profits. And it could easily correct to 270, it could easily correct to 250. But the overall trend, if you look at the trend lines, would still be up. And in fact, for my clients, we recommended buying it at 100. It went all the way to 700, and I told people to get out at 655 because the trend had reversed. That's when the new mini iPad was coming out, and everyone said, you're nuts, this stock's going to keep on going. But it didn't, and then it corrected to below 400, and right now it may be bottoming out. We're watching it quite closely. My system is designed to take the noise out of the market, and by that I mean the short-term ups and downs, which are just some small profit taking today while the overall uptrend is still intact. Now, never buy or sell if you're not sure of the trend according to your charts. How often have you heard of people buying because of a tip or a newspaper article, which later resulted in losing money? By all means, if a story looks good, and I have a lot of outside research analysts give me information, and it's a story, I put the story on a watch window and I check the trend. If it's up and you've got a good entry point where you can protect yourself with a stop loss, by all means buy. But don't buy if there's no trend, or worse still, don't buy if the trend is down. If the trend is down, sit and wait. Patience is a virtue. Never buy something in a downtrend just because you think it's cheap, because cheap can get cheaper, and the biggest losses are at the bottom, not at the top. What do I mean by that? A drop from 100 to 70 is 30 points and 30% in percentage terms, but a drop from 30 to 10 is only 20 points, but it's a whopping 65% of your money. Your best loss is your first loss. Stay out of negative trends. Then, do not hold on when in doubt. Do not get in when in doubt. If you're not sure about a stock, but you hear all these stories, wait. If it looks like a stock has started a downtrend, but you're not sure, the worst thing you can do is hold on, saying it might start at this level or that level. If the investment is falling and you're in doubt, get out. If in doubt, get out. Wait and live to fight another day. Don't use the four-letter word. And I'm sorry, I've got to use the four-letter word, hope, H-O-P-E. I'm just hoping it will turn back up. I'm hoping it will get back to XYZ level. Get out. If a new trend starts, you can always get back in. Tip 8, if possible, only trade in active markets or shares. So I like to go for stocks that have very strong earnings growth. That means the company's profits are growing faster than the market. And then their PE ratio, that's the price they're selling at, is less than the market. And then if I tie that in with trends, whoopee, we're on to a winner. So keep out of slow dead stocks. This is all about momentum. The world is more correlated today than ever before, which means the investment markets quite often rise and fall together. However, the extent to which they rise or fall is quite different. So when the markets are rising, guess what? You want to be in those markets or areas rising the fastest. And when the markets are falling, you got it. You don't want to be invested. The name of the game is to maximize profits and reduce losses. And then you employ the speed of money technique to compound your returns. When the opportunity is here, we wait to seize it, and when it's not, we wait in the safety of cash. Now, never limit your orders or fix a buying and selling price. Just trade at the market. To me, if the difference between you making money is buying at 11 o'clock or 12 o'clock or buying, at 300 or 310, then I'm not interested. We're not going for minute returns. Too many times I see people want to buy a stock but don't want to pay more than a certain price. Or if they're selling, they don't want to sell below a certain price. In normal market conditions, if the trend is up, buy. And if the trend is down, sell. Otherwise, you might miss getting in at, say, 300, as in Apple's case. And before you knew it, the stock had run up to over 600. Conversely, if the trend is down and the stock is 280, but you want to sell at 300, the next thing you know, the stock is 100 and you never sold. I'm sure many of you listening, you have stocks you wish you sold before. You buy at the price in normal market conditions. But of course, sometimes the market moves very strongly, a stock could be up over 20%, and you might need to wait for a pullback. But in normal market conditions, if you want to buy, buy. Or if you want to sell, sell. Tip 10. Don't close a trade without good reason. Follow a trend with a stop loss point to protect your profits. This brings me back to one of my pet hates. There's a saying, it's never wrong to take a profit. Well, there is. Because this is about getting the percentages in your favor of making money. If you flipped a coin, as I said before, and half the time you're right and half the time you're wrong, but when you're right, you ride your winners. Now think about this. So you bought the winning stock. You've invested in the horse that keeps winning. But because it keeps winning, you change your bet. How does that work? You see, winners keep winning. Why sell Apple shares when they're 300? If it's an uptrend, stay with it. Enjoy the fruits of your labor. If you bought it at 100, as I did advise, and you can see on YouTube in my newsletters, I did advise in March 2009, and it rises to 300, you make 3 times your money. That's great. However, if you remains in an uptrend and rises another 100% from 300 to 600, your profit, because you bought in at 100, goes from 3 times to 6 times. 100,000 invested becomes 600,000. Those who cut out early would have lost out on some 300,000 extra profit. You get what I mean? Tip 11, accumulate surpluses. After you've made a series of successful trades, put some of that money in a surplus account to use for emergencies or time of panic. We're all about capital gains. So if you've made 100,000 profit, put 50,000 into a living expenses account. To me, I don't rely on dividends. This is all about making profits and gains from the market. The dividends are secondary because we're proactive. So you can use money that you make profits from to put into a segregated account. And never purchase a share merely to obtain a dividend. There's no point in buying a stock that pays a dividend of, say, 4%, yet the stock declines 10 and 20%, and is even in a downtrend. With our system, you can use your surplus profits into an account for your income. By that I mean, if you bought Apple and you bought it at 100, you stayed with it all the way to our sell at 655. Okay, this would have taken you something like 3 years, but you could take 50,000 out, 100,000 out. We're in the capital growth business, and you can use some of these gains for your income. Perfect. Tip 13, don't be like these guys with their head in the sand. Never average a loss. This is one of the worst mistakes a trader can ever make, averaging losses. By this, I mean you buy something at 100 and you start losing. So when it falls to 90, you buy more. And when it gets to 80, you buy more. Our methodology is all about being with stocks or funds in uptrends. If you keep averaging, you could end up like some people did in Japan from 1989. It just kept going down, and even 22 years later was down 65%. Yes, minus 65% over 22 to 23 years later. You could just be throwing good money after bad. So never average losses. If the trend is down, get out. Then never get out of the market just because you've lost patience, or get into the market because you're tired of waiting. In the global financial crisis, we sold out and lost 8.8%. But the markets went on to fall 50 to 90%. If you're on the sidelines, everything was falling. Then our clients were able to get back in when the new trend starts. For example, we bought Crocs, the shoe company. It was 72 before the global financial crisis, and it fell to 25 cents. We signaled in March 2009 it was a buy at $1, and within 2 years it was $32. You see, in today's markets, there are great opportunities if you know where to look, and we do. Now just look at this. The stock was 32 2 years later. So in 2011, it was still 50% down from 72. So those buy and hold people were still nursing over a 50% loss. But people who followed my methodology would have made 32 times their money. Brings me on to avoid taking small profit and big losses. Too many times I hear people not wanting to sell when their holdings are trending downwards. They use the 4-letter word, I keep using it, hope. Just hoping it'll go back to this price. Of course it never does, and you lose more money as it drops. You need your money working hard for you. You need to cut your losses, run your profits, and thinking of getting the percentages working in your favor. 50% big profits, 50% small losses equals money equals profits. Simple, but not easy, unless you know how, and we do. Brings me on to tip 16. Never cancel a stop loss point after you've placed it at the time of you make the trade. Too many times I hear people giving excuses. Oh, it's dropped below my stop loss, but it's done it because of X, Y, Z. It'll rebound soon, or it's fallen, but it's now at another support level. If the stop loss is broken, sell. Protection is number one in this strategy. Your first loss is often your best loss because you can regroup, clear your head, and be ready to go again. If you follow our money management rules, you can actually have more losses than winners and you will still make money. How good is that? Last but not least, avoid getting in and out of the markets too often. But don't worry if these 17 tips seem a lot to take in. There are terms you may not understand, or you may think it's a bit complicated, or some people might think it's too basic. Trust me, I have a market-beating methodology that has demonstrated time and time again the ability to outperform the market consistently. No, you don't look at screens all day. No, it's not a get-rich-quick system. It's a consistent methodology that follows the KISS principle. Keep it simple, stupid. From as little as 20 minutes per day, you could be on to really profitable investments with a strategy that keeps your money safe. The key to long-term success is minimizing any downside and maximizing upside, and we have the world of opportunities. So please come and join me. I'm really looking forward to seeing you in October, and I'm going to show you the world of investments like you've never seen it before. I'm going to show you trends across 46 world equity markets, from Brazil to Russia, from England to Australia, China to India. And then I'm going to show you a little thing about focus and how we pinpoint those stocks that are doing and outperforming the rest of the market. So I thank you for listening to me. I look forward to speaking to you again and meeting you at the Millionaire Masterclass. From Graham Bibby, have an amazing day.